Hello, rooted ones. Welcome back to another session where we break down the complicated into simple terms. Today, we're talking about corporate changes and dissolutions. What happens when a company decides to make a big move or close its doors? These are major moments in a business's life. So let's dive in and make sense of them. Fundamental changes in corporations, procedures, and approvals. Every company goes through changes, but some are so big that they're called fundamental changes. These include things like mergers, selling off assets, or amending the company's foundational documents. Here's how it works. Board of Directors. The directors propose the change and approve it first. Shareholders. All shareholders are notified and vote on the change. State filing. If approved, the company files documents with the state to make it official. Think of it like planning a wedding. The directors pick the venue, the shareholders RSVP, and the state handles the marriage license, merger, consolidation, and share exchange processes. Let's talk about 3 ways companies combine or work together. Merger. 2 companies join forces, but only one survives. For example, if Company A merges with Company B, Company A might keep its name while Company B disappears. Consolidation. 2 companies come together to create an entirely new company. Imagine Company A and Company B merging to form a new Company C. Share exchange. One company buys all or most of another company's shares, but lets it continue operating as a separate entity. Each of these requires approval from directors and shareholders and involves filing with the state. It's like teamwork on a corporate level, dissolution of business entities, steps, and legal considerations. Sometimes a business needs to close its doors for good. This process is called dissolution, and here's how it happens. Deciding to dissolve. Partners in a small business might agree to shut down. In a corporation, the board and shareholders must approve the decision. Notifying creditors. The business informs creditors and settles any debts. Winding up. The business sells off assets, pays bills, and distributes what's left to owners or shareholders. State filing. Finally, the company files dissolution papers with the state. Think of dissolution like cleaning up after a party. You put things away, settle any tabs, and officially call it a night. Winding up a business. Distribution of assets and debts. After deciding to close, the company must wind up its affairs. This is about being fair and responsible. Here's the typical order. Pay creditors first. All debts, including those owed to employees or partners, are paid off. Return investments. Owners or partners get back the money they initially put into the business. Distribute remaining profits. If there's anything left, it's divided among the owners or shareholders. If there's not enough money to go around, losses are shared based on agreements made when the business was formed. It's like splitting the bill at a restaurant. Everyone gets their fair share, whether it's a profit or a loss. Wrapping it up, and that's it, rooted ones. We've covered what happens when companies make big changes, join forces, or decide to shut down. These processes might sound complicated, but at their core, they're about fairness, organization, and following the rules. If you found this helpful, don't forget to like, share, and subscribe for more easy-to-follow explanations. Stay rooted, stay informed, and keep growing.